Ready to plunge into the world of foreign exchange? We're about to untangle what shapes currency values and those global finance mysteries.
It's amazing how events that seem, well, kind of illogical in the market can make sense once you really get risk and how investors act.
Our guide is Foreign Exchange, Practical Asset Pricing, and Macroeconomic Theory by Adam S. Iqbal. He's not just an economist, though,
Right. He's a managing director at Goldman Sachs.
leading their FX options trading worldwide. Oh, and he also wrote Volatility, Practical Options Theory. So safe to say we're with an expert.
Having someone who's actually worked in these markets for years adds a whole other level to his analysis.
Absolutely. What we want is for you to walk away knowing how those exchange rates get set, the power of risk premiums, and how big things like inflation and interest rates hit currencies. Consider us like your translators for the hidden logic of global finance.
We'll look at how everyone, from individual investors to entire governments, deal with uncertainty and risk. Often, it's more predictable than you think.
The book starts with a head-scratcher. Why do government bond prices often go up during recessions, when a country's finances are getting worse? Makes no sense at first glance.
It's the whole safe haven thing. When things get rough, people want what seems less risky, like U.S. government bonds. More demand equals higher prices, even if the economy's saying something else.
So it's psychology as much as numbers, that flight to safety.
Exactly. And currencies do the same. Look at 2008.
The Aussie dollar, the krone, those are seen as riskier. They went down.
Yeah.
But the US dollar, Swiss franc, Japanese yen, those went up.
Spot on. Even though the U.S. was kind of at the heart of the mess, the dollar got stronger. People wanted that safe haven.
So this is where risk premiums come in. You want higher return potential if you're taking on more risk.
And get this. Knowing about risk premiums is key to understanding those day-to-day price jumps and dips in currencies, all sorts of assets. It's like the invisible hand guiding things.
But what creates these premiums in the first place?
To get that, we got to go deeper. It's not just about making the most money for investors. It's minimizing risk so they can keep spending steadily over time.
That's stability desire. It makes them go for assets that cushion against shocks, even if the returns are smaller.
Think of, like, a bookie setting odds for an election. Those odds aren't just about who's likely to win. They also factor in how much people are betting, right?
So it's mixing the actual odds with how the betting crowd feels.
Yeah, risk-adjusted probabilities, or Q probabilities, different from the plain P probabilities. This helps us see how money flying around and how investors feel push prices away from just the straight odds.
Challenges the idea that markets are perfectly rational and efficient all the time.
Right. Volatility, which seems crazy, can actually come from investors making totally sensible choices for their portfolios. Everyone's trying to balance their risks.
Like those market swings that seem chaotic. They're everyone trying to manage risk together. Okay, let's switch gears to the real exchange rate.
It's more than just swapping currencies. It compares how much things cost in different countries, factoring in the exchange rate and price levels. Like, how much can you buy with your money?
So let's say buying some fancy gadget in Europe versus the US. The real exchange rate tells us the relative cost after the currency swap.
There's this model, purchasing power parity, or PPP. In theory, the real exchange rate should be 1.0, meaning that gadget costs the same in both places after the conversion.
But the world's messier than that. Does this PPP actually work?
It's a good starting point, but you got things like shipping costs, tariffs, even what products are available in each place. It all throws things off from that perfect 1.0.
Not every product's easy to ship around, and trade barriers mess things up. It's comparing apples to, well, not quite apples.
Models are useful, but they simplify things for sure.
Okay, so how do exchange rates, interest rates, and inflation all play together in this big currency dance?
When people expect inflation, that hits exchange rates directly. If one country's inflation is expected to be higher, its currency usually weakens, its buying power eroding faster.
Like a slow leak in a balloon, the value kind of deflates.
Which brings us to covered interest parity, or CIP. This explains forward exchange rates, what you'd lock in for a future transaction. It's all based on the interest rate difference between countries.
So if one country has higher interest, it attracts money from places with lower rates. That makes the higher rate currency go up, right?
Right. Imagine the Fed suddenly raises rates out of the blue. That'll pull in investors from everywhere because they want those returns. Higher demand for U.S. dollars, boom, it appreciates.
A rate hike surprise is like a magnet for money. But what if inflation spikes unexpectedly?
Let's say U.S. inflation jumps way higher than anyone thought. Now, if investors want to keep the same real yield, meaning their buying power after inflation, they'll need higher nominal yields to make up for it.
Kind of like workers demanding a raise when things get more expensive?
Exactly. This can devalue the dollar because that lost buying power gets factored in. It's this constant tug of war between interest rates and what people think inflation will do.
And we can't forget risk premiums. Where do they fit in?
They're huge in deciding which way exchange rates move and how much. Imagine, alongside that inflation spike, holding U.S. assets gets riskier. Maybe there's global tension or worries about the U.S. economy.
Double whammy for the dollar.
Mm.
Inflation and risk both rising.
The dollar would plummet even more. Inflation eats its buying power, and the extra risk makes investors want even more compensation.
It's like a financial thriller. Exchange rates are constantly moving, reacting to economics and psychology both. Let's bring in FX options now. How do those help manage currency risk?
FX options give you the right, but not the obligation to buy or sell currency at a set price in the future. Great for managing volatility risk.
Like insurance against those wild exchange rate swings. What about this delta hedging thing I've heard about?
That's a strategy to cancel out the effect of price changes in, well, whatever you're trading. So with currencies, you take opposite positions elsewhere to protect yourself if the option's value jumps around.
A safety net for market ups and downs, basically. What's interesting to me is FX options' connection to volatility itself.
Often they've got a negative risk premium. That's cause people will pay extra for the protection options give, especially when the economy's shaky and volatility is high. Options become more valuable then.
Paying a premium for peace of mind during those financial storms.
Then there's the volatility risk premium, or VRP. This is the difference between how volatile the market thinks things will be versus what investors actually expect.
So volatility isn't random, it's tradable with its own rules.
And knowing those rules gives you insight into market sentiment and where prices might go.
We've done risk premiums, the real exchange rate, inflation and interest rates, even FX options. But how does this all connect to the big picture of macroeconomics and currency values?
That's where the balance of payments, or BOP, comes in. This tracks everything a country does with the rest of the world. Trade, investments, money moving around.
Like a national financial statement, showing its global dealings.
And countries that export more stuff than they import, running a current account surplus, they build up claims against those consuming more than they make.
Like earning IOUs from the rest of the world. Does that automatically make their currency stronger?
Funny thing is, even if you're constantly in a current account deficit, it doesn't always mean your currency's weak.
Now that's unexpected. How come?
Take the US. They've had deficits for ages, but the dollar is still strong. It's because everyone wants US financial assets. Global investors, they love the stability, how easy it is to trade, and how deep the US markets are, especially safe havens like treasury bonds.
So it's faith in the U.S. economy, even if they're buying more than they sell. Shows that economics isn't just simple addition and subtraction, it's about all this global money flow, confidence, and how people see risk versus reward.
The US case is a great example because it breaks the usual link people assume between trade imbalances and currencies.
This deep dive is full of twists. Okay, next we got to unpack savings, investment, and the whole twin deficits thing. What are they and why should we care?
Twin deficits is when you've got a government budget deficit, meaning spending more than they take in, and a current account deficit, more imports than exports. It's all tied to a nation's savings, investment, and that current account balance.
Let's untangle this step by step.
The current account balance is basically a country's savings minus its investments. Anything they make but don't use or invest domestically gets exported, adding to the current account. Invest a lot but don't save much. You're probably importing more, leading to that deficit.
And the twin part is when the government's also in the red, spending more than their revenue.
Now, a bigger current account deficit can be worrying, but it doesn't always mean the currency's going to tank. You got to look at the why. If a country is attracting tons of investment because it's got good growth prospects or a business-friendly environment, that deficit might be fine.
The story behind the numbers, not just the numbers themselves.
Yep, investors look at the quality of those deficits, not just the size. If it's from investments that'll make the country richer later on, that seem better than just overspending, either by people or the government.
Like taking out a loan to start a business that's got potential versus racking up credit card debt on random stuff. What you spend on matters, and so does whether people believe in the country's long-term future.
Great analogy. It really shows how spending and investment decisions have consequences that last.
This is starting to click. So how do policymakers deal with this whole mess of exchange rates, interest rates, and keeping things balanced? That's where the Mundell-Fleming model comes in, right?
That's the one. It's a cornerstone of how we understand economies that are open to the world. It lays out how monetary and fiscal policy play together with exchange rates.
Lay it on me.
One big takeaway is the policy trilemma. A country can only pick two out of three things: fixed exchange rate, free movement of money, and controlling their own monetary policy. Shows the tough choices governments got to make in our globalized world.
Like juggling, you can only keep two balls in the air at once.
For example, if you want a fixed rate A&D money flowing freely, you lose control of your interest rates. You're basically copying whoever you're pegged to.
That's a big trade-off.
Or if you want independent monetary policy A&D free money flow, the fixed exchange rate's got to go. Your currency floats freely. There's no easy answer. Every choice has its downsides.
Policy trilemma forces you to pick your battles based on what your economy needs. And it shows how important it is to think about the long game, especially with finance being so global.
Exactly. It shows how linked the world economy is and how much policymakers are limited in what they can do.
Reminds us that there's always a trade-off. Every decision costs something. This deep dive is turning into a masterclass in economic detective work. We've danced around inflation but haven't tackled it head-on. What is it really, and how do we measure the darn thing?
Inflation's basically when prices for everything, on average, keep going up over time. But measuring it? Trickier than it seems. Different methods give different results, and they all have their pros and cons.
Okay, hit me with those inflation metrics.
One common one is the Consumer Price Index, or CPI. It tracked how prices change for a bunch of everyday things that people in cities buy, like monitoring the cost of a virtual shopping cart.
So we're watching that cart's price tag change month to month.
The CPI is a last bearers index, though. It uses a fixed list of goods based on how people used to spend. Problem is, if people switch to cheaper stuff when prices rise, the CPI makes inflation seem worse than it is.
So it assumes we buy the same amounts of everything, even if we're swapping things out because of price changes.
That's the catch with last bearers. It misses how people actually react to price changes.
What about other ways? I've heard of the GDP deflator.
The GDP deflator is another big one. It compares nominal GDP, the total value of everything produced, to real GDP, which is adjusted for inflation. It tells us how much of GDP changing is from actual more stuff being made versus just prices going up.
Separating real growth from just inflation fluff, then.
But it's a passage index, meaning it uses a basket of goods that keeps changing based on current spending. It tries to catch those shifts the CPI misses, but that changing basket makes comparing over time tough.
Like comparing apples and oranges, but the types of apples and oranges keep changing too. So both CPI and GDP deflator have their quirks. What about this PCE thing economists talk about?
PCE, or Personal Consumption Expenditures Price Index, is the Fed's favorite. Like the deflator, it's got a changing basket, but it includes prices from nonprofits that help households, so it's wider than the CPI.
More complete view of price changes across the whole economy.
And it uses chain weighting, a fancy way to average those price changes, so it's less biased than the fixed weight ones like CPI.
Sounds like PCE tries to strike a balance between keeping up with how we spend and still being reliable over time.
Each measure tells us something different about price changes. The takeaway is to be aware of the nuances when you're looking at economic data.
I'm feeling more inflation savvy already. Now let's get to the theories that try to explain what causes it in the first place.
One of the big ones is monetarism. It says inflation comes down to how much the money supply changes.
Remind me how those two are linked again.
The equation MVPY is key here. M is money supply, V is how fast it changes hands, velocity, P is the price level, Y is the real output. It's like the core relationship connecting money, economic activity, and prices.
So money circulating, how it's used, and overall stuff being made. Those all play together.
Monetarists say if the money supply grows faster than real output, boom, you get inflation. Like pumping too much air into a balloon, eventually it pops. But critics argue that the velocity part, how fast money moves around, is unpredictable, so it's hard to use this theory all the time.
It's not just the amount, it's how it's used in the economy that matters.
Another theory, the fiscal theory of the price level, or FTPL, focuses on government debt and spending decisions.
Ah, the land of government budgets. How does FTPL explain inflation then?
It says the real value of government debt, after you count for inflation eating away at it, has to eventually match the present value of future government surpluses, excluding interest payments.
So, like, if the government keeps borrowing without enough income to cover it, something's got to give.
And the FTPL says inflation can be that give by making that outstanding debt worth less in real terms.
Sneaky way for governments to shrink their debt burden using inflation.
But like with most economic ideas, there's pushback. Some folks aren't convinced it reflects how governments and central banks actually act in the real world.
Never a simple answer at economics, huh?
Nope. But each idea sheds light on a different part of these complex things.
Okay, what about new Keynesian models? Where do they fit in?
These are newer mixing ideas from Keynesian and neoclassical economics. Big thing is, they say prices aren't perfectly flexible.
Meaning what, exactly? And how does that tie to inflation?
Sticky prices means prices don't instantly react to changes in supply and demand. This can cause hiccups in how much stuff gets made and employment while the economy adjusts.
Like, prices have some resistance to those quick market shifts.
Then there's rational expectations. This means people, like consumers and businesses, make decisions based on what they think will happen using all the info they have.
Not just reacting to now, but trying to guess the future.
So new Keynesian models say inflation can come from demand shocks, sudden changes in spending, or supply shocks, like problems with production or costs changing. They're trying to capture the real world where things aren't perfectly balanced or predictable.
Recognizing those imperfections in the market that can mess with inflation.
Right. New Keynesian models acknowledge that people don't know everything and markets don't run perfectly smoothly. Those are part of why inflation's so tricky. Back again for more on foreign exchange and all things macro.
Picking up where we left off, diving deeper into inflation and how it ripples through global markets.
We looked at how to actually measure inflation, with each method giving us a slightly different piece of the puzzle.
CPI, GDP deflator, and of course the Fed's favorite, PCE.
Now's the time to get into those theories, trying to explain what causes this tricky thing we call inflation.
Let's get to the bottom of why prices keep going up, hitting all our wallets.
One big idea is monetarism. It basically blames inflation on too much money being printed.
Intuitively makes sense. Flood the economy with cash, each dollar's worth less.
Imagine way more money floating around, but the amount of actual stuff we make and do stays the same. Every dollar's chasing fewer goods, prices go up.
Like a game of musical chairs, more players, same number of chairs. Competition heats up.
Monetarists love the equation. MVPY. M's the money supply. V, how fast it changes hands. Key, the price level, and Y, real output.
It's that core link between money sloshing around, what we're doing in the economy, and the price tags on everything.
The equation's saying if M grows like crazy but V and Y don't keep up, P's got to rise.
Too much of anything, even money, can mess things up. But people who aren't sold on monetarism say predicting velocity, how fast money changes hands, is near impossible. So using this theory consistently is hard.
Kind of like the weather. Sometimes you can see it coming, other times it's chaos.
So monetarism is a good framework, but it doesn't perfectly predict inflation every time out in the real world.
Another theory, fiscal theory of the price level, or FTPL for short, focuses on government debt and how they spend.
Government budgets, always a fun topic. How's this one explain inflation?
It says the real value of what the government owes after inflation eats away at it has to line up with the value of future government surpluses, but not counting interest payments.
So if the government keeps spending more than it takes in and borrowing to cover the gap, something's got to break.
FTPL says inflation can be that break, makes the debt worth less in real terms.
Like a sneaky way to shrink the debt using inflation, making it less of a burden. But as with everything in economics, there's always someone saying, hold on. Some don't buy that this is how governments and central banks actually operate.
Economics is full of debate, that's for sure. FTPL gives us a way to think about how government spending and inflation are linked, but it's not the whole story.
All right, let's check out another school of thought. New Keynesian economics. What's their take on inflation?
New Keynesian models are a bit of a mix, taking from both Keynesian and neoclassical ideas. They say prices don't always move smoothly and instantly.
Okay, and what does that mean in plain English? How does it connect to inflation?
Sticky prices is the term. Means prices don't jump immediately when supply or demand changes. Can cause bumps in output and jobs while the economy catches up.
Like there's some resistance built into the system, stopping prices from changing instantly.
And they also factor in rational expectations. That means people like us regular folks and businesses make choices based on what they think will happen in the future, using all the info available.
Not just reacting to now, but trying to be smart and guess what's coming next.
Putting it all together, new Keynesian models say inflation can be caused by demand shocks, sudden changes in spending, or supply shocks like disruptions to production or costs going haywire. They're trying to capture that real-world messiness where things aren't predictable and in perfect balance.
So they're accounting for the fact that markets aren't perfect and can throw us curveballs, which then impacts inflation.
Exactly. New Keynesian models acknowledge we don't have a crystal ball and markets don't run like perfectly oiled machines. That's part of what makes inflation so complex to deal with.
All these different theories about inflation are fascinating, but how do they play out in foreign exchange? How do these ideas affect what we see with currencies in the market?
This is where understanding interest rate parity and those risk premiums is key. Remember, interest rate parity says that if interest rates are different in two countries, that difference should show up in the forward exchange rates.
Higher rates in one country attract money from places with lower rates, making that higher rate currency appreciate.
Now, think about inflation's role. If a country's got inflation going crazy, their money's buying power is shrinking. Investors want higher interest rates to make up for that loss.
Like when everything costs more, workers want a raise to keep up. Same idea. Investors want higher returns so their money isn't losing value.
This back and forth between inflation and the difference in interest rates is a big driver of those exchange rate swings we see.
So it's not just about chasing the highest return, it's about protecting your money from inflation, eating away at it.
And don't forget those risk premiums. Investors are also judging how risky it is to hold assets in different countries.
How do risk premiums factor into all this?
If a country's got political instability or their economy's looking shaky, investors want a bigger risk premium to hold assets in that currency. Puts downward pressure on its value.
Like adding an extra fee because there's more uncertainty, a higher chance of losing money in that environment.
So exchange rate movements are a mix of interest rate differences, inflation expectations, and those risk premiums, economics, and psychology all rolled into one.
This deep dive is like pulling back the curtain on the wizard of currency markets. We're getting a peek at how the global financial system actually ticks.
We're starting to see how these big, abstract economic ideas translate into real action in the markets.
But let's not get lost in the weeds. How does all this affect a whole country's economic health and stability? That's the big question, right?
That's where looking at the balance of payments, national income accounting, and that Mundell-Fleming model becomes really useful. They give us insights into the forces shaping currency values and how well a country's economy is doing overall.
I'm ready to connect the macro dots.
The balance of payments, or BOP, tracks everything a country does with the rest of the world trading stuff, investments, money flowing in and out. It's like their financial statement, showing their global activity.
A window into a country's economic relationships with everyone else.
By analyzing the BOP, we can see their current account balance. That's the difference between what they export and import.
A surplus means they're making more from selling stuff to other countries than they're spending on buying stuff from them.
Exactly. While a deficit means the opposite, they're importing more than they're exporting.
But as we learned earlier, a deficit isn't always a bad sign.
It's all about what's causing it. If it's because they're investing a lot in things that'll make them richer later on, it could actually mean their economy is healthy and growing.
Like borrowing money to invest in education or training, expecting to earn more in the future.
But if it's from people going on spending sprees or the government wasting money, that's when you worry about things being sustainable in the long run.
Like racking up credit card debt on stuff you don't need. Not the best financial plan. So the balance of payments gives us clues about how a country is engaging with the world economy, which helps us understand what's affecting their currency.
And it's closely tied to national income accounting, which measures the overall level of economic activity within a country.
Can you remind us of those key national income accounting concepts?
Gross domestic product, or GDP, is the big one. It adds up the total value of everything produced inside a country over a specific period, usually a year.
Measuring how much stuff the economy is actually turning out.
We can break down GDP into its parts: consumption, investment, government spending, and net exports.
Like a recipe, seeing how much each ingredient contributes to the final dish.
That breakdown tells us what's driving economic growth and where there might be weaknesses.
Like a doctor, checking your vitals to see how healthy you are overall. Now let's circle back to the Mundell-Fleming model. It helps us see how monetary and fiscal policy interact with exchange rates in an open economy.
This model shows how changes in monetary policy, like tweaking interest rates or doing quantitative easing, can affect exchange rates through how they impact money flowing around globally.
We talked about how higher interest rates attract foreign investment, pushing a currency's value up. Lower rates can do the opposite.
It also shows how shifts in fiscal policy, like changes in government spending or taxes, can impact exchange rates by affecting overall demand and economic activity.
So there's this intricate dance between monetary policy, fiscal policy, and exchange rates, each one stepping on the other's toes, so to speak.
And the Mundell-Fleming model emphasizes the policy trilemma, reminds us that governments have tough choices to make when managing their economies in our globalized world.
That balancing act of trying to keep a stable exchange rate, let money flow freely, and still control their own monetary policy.
The decisions they make in this area have big consequences, affecting their economies and their currencies, interest rates, inflation, economic growth, the whole shebang.
This deep dive is giving us the tools to understand how those big macroeconomic forces interact, showing us just how interconnected the global financial system really is.
It's like we're getting access to the control panel of the global economy, seeing how all the levers and dials work together.
We've looked at all these objective factors driving the markets, but what about the human element? How does psychology and sentiment play into these seemingly rational economic forces?
That's where behavioral economics steps in. Reminds us that markets aren't always driven by cold, hard calculations. Our emotions, biases, and that herd mentality all influence what happens.
It's acknowledging that behind all the numbers and charts, there are real people making decisions. And those decisions are sometimes driven by feelings, not just logic.
Investor sentiment, which is the overall mood or feeling investors have towards a specific asset, the whole market, or even the entire economy, can really swing things.
Like the emotional temperature of the market, sometimes it's hot, sometimes it's cold.
Sentiment is shaped by all sorts of things: news headlines, what's trending online, economic data releases, even global events.
It's like the market is constantly taking in information, but filtering it through the lens of collective psychology.
And shifts in sentiment can really move those asset prices, sometimes pushing them far away from what the fundamentals would suggest.
Shows that markets aren't always perfectly efficient or predictable.
Important to remember, though, behavioral economics doesn't throw traditional economic theory out the window.
It's not about ditching those rational models entirely. It's about adding to them and making them more realistic.
Behavioral economics adds that human element, acknowledging that we don't always act in a perfectly rational textbook way.
It's like adding a dash of reality to those economic equations.
Understanding these behavioral quirks can help us make smarter decisions and avoid those common traps that can hurt us financially.
Like gaining a superpower, seeing through those emotional tricks and making choices that are actually good for us in the long run.
As we wrap up this part of our deep dive, let's think about what this knowledge means for us as we navigate the global economy.
Because at the end of the day, understanding economics should help us make better decisions in the real world, right?
Absolutely. Whether you're an investor, a business owner, or just someone trying to make sense of it all, this knowledge can empower you.
I'm all ears for those practical applications.
For investors, understanding how exchange rates move can help them judge the risks and rewards of putting their money in foreign assets. It's not just about picking the right stocks or bonds, it's about understanding how currency fluctuations can affect your overall returns.
Those currency swings can boost or wipe out your gains, making global investing even trickier.
For businesses operating internationally, understanding how exchange rates work is crucial for managing currency risk and making smart decisions about pricing and hedging.
It's about factoring those currency fluctuations into your business strategy, knowing that they can impact your bottom line.
And for all of us, understanding how inflation erodes our buying power helps us make better financial choices, whether it's negotiating our salaries, planning for retirement, or even just managing our daily spending.
Like gaining a superpower, seeing through those tricky price changes, and making choices that protect our financial well-being.
This deep dive is equipping us with the knowledge to navigate the complexities of the global economy with more confidence.
But our exploration isn't over yet. In Part 3, we'll continue to delve deeper into the mysteries of foreign exchange, asset pricing, and macroeconomics.
There's always more to discover on our quest for economic enlightenment.
Welcome back for our final exploration of the fascinating world of foreign exchange.
We've covered a lot of ground, haven't we? From those risk premiums and how exchange rates move to those theories about inflation and all those macroeconomic frameworks.
We have, but there's this one key aspect we haven't really dug into yet: how psychology can impact market behavior. People forget about that all the time.
That's where behavioral economics comes in. It's like a bridge between psychology and, well, regular economics.
It recognizes that markets are made up of people, right? And people aren't always those perfectly rational robots that traditional economics assumes.
Exactly. Behavioral economics looks at how our emotions, biases, and, those mental shortcuts we take can lead to decisions that don't fit those purely rational models.
So it's adding that human element, that messiness, to how markets actually work.
One big concept is loss aversion. It's that tendency we have to feel the pain of losing something way more strongly than the joy of gaining the same amount.
It's like they say, losses loom larger than gains. Losing a dollar just feels worse than gaining a dollar feels good.
And this difference in how we react to gains and losses can push investors to make choices that, from a purely rational view, just don't make sense.
Like holding onto a losing investment way too long, hoping it'll come back, even when all signs point to, nope, get out.
Or the opposite, selling a winner too early, scared that you'll lose those profits.
Our emotions can really mess with our judgment, making us do things that aren't good for our wallets in the long run.
Another interesting one is herd behavior. It's following the crowd, even when what they're doing goes against what you know or believe.
Safety in numbers, even if everyone's running towards danger.
In financial markets, herd behavior makes those booms and busts even bigger, creating those bubbles that pop and, well, usually someone gets hurt.
It shows how powerful that shared feeling of fear or greed is, how it can drive those huge swings in the market.
Which brings us to market sentiment. That's the overall mood or attitude investors have toward a certain asset, the whole market, or the entire economy.
The market's emotional weather, changing between sunny optimism and gloomy pessimism.
Sentiment is shaped by tons of things: news, economic data, what's happening globally, even what's trending on social media.
It's like the market's a giant antenna, absorbing information, but interpreting it through everyone's collective feelings.
And changes in sentiment can have a massive impact on prices, sometimes making them totally disconnect from what the actual fundamentals say they should be.
Proof that markets aren't always perfect or easy to predict.
But it's important to remember that behavioral economics isn't saying traditional economics is wrong.
It's not about throwing out those rational models entirely. It's about making them more realistic and nuanced.
Behavioral economics adds that human touch, saying, hey, people don't always act like those perfectly rational calculators.
Like adding a little bit of real life to those economic equations.
And by understanding these quirks in our behavior, we can be more aware of our own decision making, avoiding those traps that can wreck our finances.
It's self-awareness, right? Recognizing our tendencies and making better choices because of it.
So, as we wrap up this deep dive, let's recap a few key points.
I'm ready for the wisdom.
First, exchange rates are influenced by both hard economics and psychological factors.
So those objective numbers like interest rates and inflation get mixed with subjective things like sentiment and how risky people feel things are.
Second, economic models, while helpful, are just simplified versions of reality.
Like maps to navigate a complex landscape. But sometimes you got to go off-road and adapt when the terrain changes.
And finally, never underestimate how much psychology can impact what happens in the market.
Because behind all those charts and economic data, it's people making decisions. Sometimes rational, sometimes emotional, but always shaping the course of events.
This deep dive has given us a pretty solid understanding of foreign exchange and the world of macroeconomics.
We explored what drives currencies, from those core economic factors to those psychological influences we often forget about.
We tried to blend theory and practice, giving you both those conceptual frameworks and real-world examples to illustrate.
What I found most helpful is how you tied it all together, made those connections clear.
Economics is always changing. We get new data, refine our understanding of how things work. It's a journey.
This deep dive was a great starting point. Now we've got the knowledge and tools to navigate the global financial world with more confidence, wouldn't you say?
Absolutely. Remember, the learning never stops. Keep exploring and asking questions.
Couldn't have said better myself. Thank you for taking us on the journey through foreign exchange, asset pricing, and all those macroeconomic theories.
The pleasure was mine. Till next time, stay curious.